Good morning, everyone, and thank you for joining us this morning. Today we have for you CapitaLand Limited update, as well as Oxley Holdings and Singapore Press Holdings Phillip on the ground. We also have our Singapore REITs monthly and Singapore weekly to wrap things up. So without further ado, I will get started with Singapore REITs monthly. Okay, so as you can see in the graph, the blue line represented by the REIT index is actually currently underperforming the real estate developer index as well as the STI index. In the last month, the REIT index actually improved by 2.9%, and catching up to the real estate developer index as well as the STI. So if you recall, April was quite an active month for the REITs in terms of acquisition, and this deal momentum carried into June. So we saw some of the hospitality as well as the retail REITs getting a piece of the action. Escort acquired 3 Japan rental housing assets for $85.2 million at an EBITDA yield of 4%, as well as a 45% stake in a student accommodation development project in South Carolina at an EBITDA yield of 6.2%. Lendlease REIT is also increasing its stake in GEM from 3.75% to up to 31.8%. Prime US REIT will also acquire 2 office towers, one located in San Diego and one in Florida, for a total consideration of $245.5 million US dollars. Developers that may actually tap the Singapore market through REIT IPOs in the next 12 months, these include Mapletree Investments, 1 billion student housing REIT IPO, as well as CDL's UK commercial REIT. And the latest IPO that has floated to the market is Digital Realty's evaluation of a data center REIT with an initial portfolio of 10 assets. So now moving on to interest rate performance. So as you can see in the graph over here, the red line is denoted by the 10-year SGS, or 10-year bond yield for short. And that has actually come down. It actually spiked to the high of 1.72% in April, and that has come down to 1.56%. And according to Bloomberg consensus forecast, the 10-year SGS will remain below 1.6% from 2021 to 2023. And of course, this level at 1.6% is below the 5 and 10-year historical average. In other words, right, we are already close to the 1.6% level, and therefore we expect further interest rate growth to be capped in the near term. And because this, So overall, you'll see later that we expect that the REITs DPU growth to actually outpace interest rate growth. Okay, so in terms of yield spread, this is where we are. The dark blue line here is the dividend yield spread on a trailing basis, on a 12-month trailing basis. So currently you can see that the yield spread is actually below the lower green line, and it is at the negative 1.4 standard deviation level. So this yield spread is actually 2.5%. Yeah. Okay. So however, if we look at the forward dividend yield spread, is actually 3.6%. This is at the 0.2 positive 0.2 standard deviation level. So it's close to the mean, the average yield where the REITs have been trading. Sorry, average yield spread. So overall, we maintain overweight call on the REIT sector, and as mentioned, we expect the DPU growth to outpace the interest rate growth, which will be kept in the near term. So if you look at the graph on the left-hand side, you see the DPU performance of the REITs in 2020, or rather the DPU growth of the REITs for 2020. And hospitality, of course, the most negative, down by about 60.4%, followed by retail, as well as the diversified REITs, with office also negative 4.5 DPU growth. So moving into FY21, we're expecting a strong recovery from hospitality as well as the retail REITs, as well as some of the diversified REITs are expected to improve by about 27%. And industrials will then show a 8.8% growth, and that is on the back of almost normalized 2020 performance. Okay. If you look at the graph on the right hand side, this is how the DPU for FY21 compares to pre-pandemic DPU levels. So most of the REITs are actually will actually perform better, show DPU that is above pre-pandemic levels. So of course, pointing out Ascott Residence Trust, where even though it's it will show about 44% DPU growth in FY21. This is not yet back to pre-COVID levels. Yeah, so the hospitality sector actually faces a relatively longer timeline to recovery. Now moving in on the separate subsectors. We have retail, which we are overweight on. Okay, so overall, the rental index has fallen by 16.5% year on year in first quarter 2021, and vacancy has improved to 8%. So this is just 0.5 percentage points shy of 1Q20's levels. And overall, our retail REITs have outperformed, maintaining occupancy of above 96%. The value proposition and the resilience of suburban malls has been validated amidst the pandemic, and they benefit from the proximity to household catchments, the increased daytime population from flexible working arrangements, as well as necessity-driven spending. Okay. Retail rents, we believe, have bottomed. However, we expect the negative reversions to continue due to the 3-year rental cycle for most of the leases. We're expecting minimal rebates, except in cases of mall closure. Landlords still remain supportive of the tenants. However, the support is likely to come more in terms of operational support in the form of advertisement and promotions, waiving of online platform fees and such. The government also has enhanced the job support scheme, JSS for short. So from the period of 16 May to 13 June, the government will give a 50% wage support for F&B operators as well as gyms, and 30% wage support for retail, cinema, and personal care services operators. Yeah. In terms of the RSI, you can see that there's a little bit of skewing of the data. So in the graph on the left-hand side, you see that April RSI actually spiked. Of course, that is because it is being measured against a low base as seen in April 2020. So more or less, you see the retail sales has sort of stabilized. The retail sales index is as of April 2021 is down by about 7.3% from pre-pandemic levels. Yeah, but of course, if you look at the months of November and December, the RSI was actually very, very close to the 2019 levels. F&B index, of course, still lagging. It's in April it was about 17.5% down from 2019 levels. So moving on to the hospitality sector. So hospitality faces a longer road to recovery. The STB is estimating a 4 to 5 year recovery timeline, and we think that the recovery to pre-pandemic levels will come only in 2023, 2024. So May's hotel RevPAR actually fell by 23% month on month. This was due to cancellations and postponements due to the 2 guest limit imposed during the phase 2 heightened alert. Year on year, RevPAR will improve by 58% from a low base. So May's RevPAR was $61, and this was 58% below the 2019 average levels. So of course, you can you can see the RevPAR in the graph on the left-hand side is denoted by the blue line, which is, this is about, 68% down from pre-pandemic levels. One of the bright spots for the hospitality sector, for the Singapore hospitality sector, is Singapore's accelerated vaccine program. So as of 25th June, 53% of the population has received at least one dose of the vaccine, with 36% of the population having received 2 doses. And from the 26th of June onwards, Singapore's daily vaccination volume has been enhanced, or rather ramped up, by about 70%. So this increases the daily doses that can be administered from 47,000 to 80,000. And with this rollout of vaccine, Singapore, of course, is contemplating and evaluating the possibility of, opening up our borders. So the government is also thinking about, substituting COVID-19 testing in lieu of stay home notice for vaccinated travelers. So this might actually provide a boost for business travel. On the flip side of things, of course, the number of hotels that are being used for quarantine purposes may taper off. Moving on to the office and industrial subsector. So there actually isn't any new data for the office and industrial subsector, but just to bring things full circle. So the Singapore office market, as well as the US office market, have experienced an increase in leasing activity in the first quarter of 2021. And this, of course, compares to the past 3 quarters where the tenants were delaying decision making. In Singapore, we're seeing that the only downsizers are namely the banks. Most tenants have chosen to retain their previous space requirements. The REIT occupancy dipped due to non-renewals, in line with the industry occupancy, which slid by about 0.1 percentage points quarter on quarter. Overall, reversions were mostly positive, mirroring a 3.3% quarter-on-quarter improvement in the rental index. So we saw the Singapore office REITs like Keppel and OUECT registering positive rental reversions of 10.4% and about 4 to 8%. US REITs also positive rental reversions. Prime, Core, and Manulife have registered a 9.5%, 5.7%, and 2.5% reversion for the first quarter of 2021. In Singapore, the supply condition, the average supply coming on over the next 5 years is about 0.7 million square feet. This is below the 5-year historical average of 1 million square feet. And not to mention, in 2021, 2022, we are expecting 3 confirmed redevelopments that will come from Fuji's Xerox, AXA Tower, as well as Central Mall. Moving on to the last subsector, which is the industrial subsector. So occupancy improved by 0.3 percentage points to quarter on quarter, and of course this is 0.7 percentage points higher year on year. As you can see, the occupancy is denoted by the red line in the graph on the left hand side. Industrial rents also grew. This is like in the second quarter of growth by 0.6%, with improvements across all asset classes. However, despite these positive stats, the industrial REITs also the industrial REITs are still a bit cautious on the rents. They think that near-term pressure on rents may continue. Like industrial asset class is the most challenged. However, Singapore's plans to boost the manufacturing sector by 50% over the next 10 years will help to soak up some of the light industrial supply, and the manufacturing activity typically occurs in light industrial as well as high spec assets. So that might actually channel some of the demand to the high spec assets as well as business parks, which is where some of the companies will choose to set up headquarters. Data centers, high-spec assets, and business parks remain favorable and supported by technology, biomedical, as well as precision engineering sectors. Warehouses will continue to benefit from higher demand from logistic players, as well as some of the players who are rethinking the just-in-time inventory management system. So due to, of course, some of the supply chain disruptions, some of the players are, of course, thinking of moving, padding their inventory and moving away from just-in-time inventory. So that might actually increase the amount of space that they will require for storage purposes. So to wrap things up, these are our stock calls. Our top picks for the REIT sector are Ascendus as well as Fraser Centrepoint Trust. So now moving on to an update for CapitaLand. So just last week, CapitaLand announced the divestment of two Japan malls at 28% above book. These two malls are located in the Greater Tokyo area, and they sold for 520 million Singapore dollars, or 42 billion Japanese yen. So this actually realizes a net gain of $109 million for CapitaLand, and these gains will be parked under CLIM's balance sheet. So if you recall, CapitaLand actually announced that they will be undergoing they have proposed a demerger where the stake of the REITs as well as the fee income and will be parked under CapitaLand Investment Management, which is CLIM, CLIM for short, and the assets that are the developmental assets which require a longer gestation period will be parked under CapitaLand Development, and that entity will be privatized. Yeah. CapitaLand also announced the development of the second logistic asset in Japan. So they will be investing about 7.5 billion Japanese yen in a 27,000 square meter logistic assets, which will be completed in the third quarter of 2023. So they have, of course, acquired this logistic asset project from Mitsui Real Estate. Some of the benefits of this acquisition, so there's actually quite limited supply of logistic development sites in Tier 1 Japanese market, and the Japan market is, of course, facing very favorable CAGR of e-commerce CAGR of 7.5%. Yeah, vacancy rates for logistic assets in the Greater Osaka area is expected to fall to 2% in 2022. So of course, this development actually follows its CapitaLand's first investment in Japan, in the Japan logistic space, which was done on November 2020 in a JV with Mitsui Real Estate to develop a 24,000 square meter logistic property in Greater Tokyo. In other news, CapitaLand also successfully obtained their private equity fund manager status in China. So this will allow CapitaLand to carry out renminbi denominated capital raising. And of course, China is one of the largest capital countries in the world. So in terms of capital, so this will allow CapitaLand to raise funds from the Chinese. And CapitaLand will target to launch its first renminbi denominated fund in the fourth quarter of 2021. CapitaLand has 27 years of operating track record in China. So of course, this they are not new to the Chinese market. Yeah. This is in line with CapitaLand's transitioning to a asset-light and capital-efficient model. So of course, we see that CapitaLand is divesting its stakes, or rather paring down its exposure to the retail assets. At the same time, they are actually trying to pivot into the new economy assets. In total, CapitaLand, as of May 2021, CapitaLand has divested about 1 billion worth of assets and invested 2.7 billion worth of assets. And mostly 95% of them were in new economy assets. Yeah. So overall, there's no change in our outlook. We still maintain our buy call on CapitaLand and our target price of $4.38. Yeah. I'll now pass the time on to Timothy for Oxley.
Thanks, Ned. Next slide, please. Okay, we have Oxley just issued a new bond last week, and they had a roadshow for the new bond issue. So here's some updates on their business. Just a background, Oxley is a real estate developer and investor, market cap about $1 billion. So they do development both in Singapore and international, and they also own hotels in Singapore, Novotel and Sophie. They own some in the near the Clarke Quay area, and then also they have this small equity stake in Aspen Group. The concern with regards to Oxley has always been their gearing ratio. So it's still at 2.33 times net debt to equity, and they target this to be about 1 times in the next few years. And how they're going to do this is through, and the reason why their debt is so high in the first place is because they acquired a lot of land back in 2017. But right now they are in a stage of completing the building of those the properties, and they've already sold most of it in Singapore, and about half of it in overseas. So they are expecting this future revenue recognition of about 2 billion in the next 3 years, and this is how they're going to pay down their debt. So from Singapore, they have about 1.6 billion of unrecognized revenue and about 350 million from overseas. This is compared to about 1.6 billion of repayable debt in the next 3 years. So they do have enough cash flow visibility to pay off the debt. It just comes down to execution. So the new bond issue of 70 million they raised last week was a 6.9 coupon 3-year senior unsecured bond that matures in 2024. And this bond will be used to help to refinance the bond that is maturing next year, another bond that matures next year in January. So the outlook for their business is for Singapore, the good thing is that they already sold about 89% of all the units, residential units in Singapore. But the construction has been delayed for 7 months. So that's why they have some cash flow issues at the moment to pay off the bond, and that's why they had to raise this bond. But the good thing about having less than very few units unsold is that if let touch wood, the government does release some cooling measures, they won't really be affected that much because they don't really have much else to sell. So they expect to sell this the remaining 300 units within 6 months. So they expect about 50 units sold each month. For overseas, it's less rosy. So they only sold about 52%, and they have about 2 billion worth left to sell. And this is partly due to the slowdown due to COVID-19 restrictions, both in Malaysia and also Vietnam. But they do expect still revenue recognition of about 350 million. And they are also going to launch a new project in UK called the Deanston Wharf of 323 effective stake gross development value. So this will help future cash flows to help pay off the future debt also. This will help with cash flow visibility. So if you look at the chart on the top right-hand corner, this is the debt maturity profile compared to the amount of receivables they expect to receive in the next 3 years. So the blue bar is the debt maturing, and the red bar is the amount of cash that they expect to receive in the next 3 years. So it looks like they do have enough revenue visibility in the next 3 years to pay off the repayable debt. It's just that the timing issues due to construction delays. The last thing is that we don't expect the debt to really rise as much as what it did in 2017. This is because the management said that they will not be acquiring any more new land bank in the next 3 years, 2 to 3 years. Reason being is because right now there's a shortage of land, first of all, in Singapore, and that the prices are too high and the margins are too thin. This is due to the shortage. So the bids are a bit too high and the margins too thin for them. So right now, Oxley has 3 bonds. So one maturing next year in January, then February, and then after that in 2024. So it's 2022, 23, and 24 each 1 year. And the The bond that we like to highlight now is the one that is maturing next year. So apparently there's still sellers for this bond, even though Oxley successfully raised the bond last week to help to pay off this bond. So this bond gives a yield of about 4.6% for just holding it for 6 months. So it's quite attractive in our view. Yeah, so that's all for me. I'll pass my time on to Paul.
Okay, thanks, Timothy. Next slide. Next slide. Okay, back. Okay, this is just an update of some of the macro news in Singapore and even globally. So in Singapore, we released our PMI numbers. So the numbers are still good at 50.8 compared to the prior month of 50.7. So it just shows that manufacturing activity is still expanding, especially compared to, and it's even higher than in June 19, the pre-COVID levels of 49. Another piece of good news is that the loans is starting to eke up. I mean, I wouldn't say it's like rallying, but you're starting to see some mild rebound. Loans growth is up about 1.2%, accelerating from the prior month in May. We also had some news on HDB price. It was up 3% quarter on quarter. In terms of headline worries, obviously, if you have like a 11% increase over 12 months, and sometimes, like we mentioned before, a rule of thumb, if you times it by 5 years, over 5 years, this could mean a 50% increase. But I think we'll explain later that over the 8 years, I think HDB prices have basically been flat. We also had employment numbers, the big news in the US, employment numbers about 850. It kind of beat expectations. It's the highest increase in jobs in 10 months. But since the pandemic, if you do the sums, we are still, I mean, the US is still down about 6.7 million jobs. Of course, there's a lot of debate whether people are just on the sidelines and whether there's even people looking for jobs. But in terms of numbers-wise, compared to pandemic, it's still been a net decline of 6.7 million. Surprisingly, the bond prices actually came off, and that was because the unemployment rate actually came down, rose actually from 5.8 to 5.9. So even though jobs improved, the bond yields actually came down. In terms of manufacturing globally, the numbers, we still see a strength in global manufacturing, although it's a bit slower than the prior month. But I think key for us is that it's actually still coming far, far above the pre-pandemic levels, which was around 50. All this we'll have charts later to elaborate. We also have Phillip on the ground on SPH. We didn't do the MM2 because it was more or less the same as what they did on their analyst briefing, but I saw a question, so later I'll just update everyone on MM2. In terms of our tactical views, we see there's global growth underway, tepid interest rates, and vaccination is underway. I mean, if you compare to a year ago, obviously the market's also improved, but if you compare to the situation a year ago where we weren't even sure if there will be vaccines out, but at least right now we are seeing vaccination underway. And when we do our numbers, we do notice that I think Europe and US could probably get fully vaccinated by this year, somewhat similar to Singapore. When you, in terms of the events, I think these are the things we're going to get, like retail sales today, FOMC minutes. This is just for an update for you. Performance webinar for this week, we've got 3. So we got iREIT, but regretfully, this is only for the TRs. And then we have Uni Asia on Wednesday, and then on Friday we have Landlease. So if you have time, feel free to register and listen in. We also have our event on Saturday, which is our Singapore strategy. And next slide, let me try to close the window. Okay, in terms of the global cases globally, you can see that there's a mild increase, the blue line, but we are still declining 23% month on month. So the pandemic is still somewhat in control globally. And I think what's in the news right now is there's a Delta variant spreading, but we are still not below the lows in February of this year, which is 354,000. UK is also experiencing 5-month high in terms of cases. Another, I guess, interesting piece of news is that the US is rolling out this digital COVID certificate. It's almost like a vaccine passport. So if you want to travel around, you need this certificate to show that you've been vaccinated. Next slide. Okay, in Singapore, we've done really well. I think the cases for the total cases over the past 1 week is 26 compared to the prior week was 95. When you listen into the minister's interview with Straits Times, he mentioned that there is no big bang opening. I think the opening will still happen, but it will be gradual. And as Natalie mentioned, these are some of the yardsticks or timelines to watch out for in terms of vaccination. So the latest number I just did a check. I think we are probably single dose about 61. So I think it gets interesting if at least single dose we can get 80%. Then we know we are quite close to that, to this so-called 80% vaccination rate. The reason why 80% is, I think in the interview also mentioned that because of the Delta variants, I think they are more comfortable if they can get a 80% vaccination rate in the population. Again, I'm not sure if they can achieve it, but I mean, that's what they're targeting. Next slide. Okay, in terms of the COVID cases, just wanted to highlight, again, this is just out of interest. I think some of the other countries where they are beginning to see some hotspots. So the table on the left is all the four ASEAN countries, the four main ASEAN countries. You can see the red line, that's where you're getting a big spike now in Indonesia. No, hopefully we don't get those. There's a risk that you get the spike, like you see in the yellow line in Malaysia. Once you get this third big wave, it's actually going to be like double or could even double the previous high. So that's a worry we have in Indonesia. And it's a bit, and also stubbornly high in Thailand, in Philippines. Yeah, they still can't get control of it. In the Europe, most countries are down, but you can see there's a big pickup in cases in the UK. Again, this is just out of interest for just an update for everyone. Next slide. Okay, in terms of that we mentioned earlier, the data kept coming out from Singapore. The table on the left is the banks. So you can see there is a pickup. Hopefully it can accelerate further, but it's another driver to grow for the banks if this happens. So you can see that loans growth is starting to pick up. The chart is pointing upwards. The table on the right is just the HDB prices around the last almost 20 years. So you can see that just a refresh. From third quarter, we had this big rally in HDB prices, which doubled. Then since then, we've actually went down 12%, and then we picked up another 11% recently. But if you do the nights, we are still 2% below the highs. So in a nutshell, almost 8 years, but HDB prices have basically been flat. So in a way, I'm not sure how the authorities will react, but I think even though we've increased 11%, but still over 8 years, the HDB prices have not gone anywhere. So I'm not sure if that will be something they will consider if they were to kind of impose any cooling measures. Again, it's an unknown. Next slide. This is just a flash on the global manufacturing PMIs. You can see that for me, I guess the strength is that it's above even higher than the pre-pandemic levels, which is in 2019. The one on the right is just to show you the monthly jobs increase. You can see that during the pandemic, we had this big job loss of 20 million in the US. It has been recovering, but it has not fully recovered to pre-pandemic levels. So we're still 6.7 million down. Next slide. Okay, this is our model portfolio. I know it's a very noisy chart, so let me just run through and just give an update. This is our so-called absolute 10 model portfolio. Absolute supposed to be absolute return, not the vodka. The table on the left is the 10 names. So you can see the performance. So what did well? I think the STI was down about 1%, but what did well was the yield names. So you can see the Escort REIT, Asian Pay TV. I think you don't have to move the mouse. I think we can see that Asian Escort REIT, Asian Pay TV, Manulife. You can see that the yield names have done well. Even Fraser Centrepoint has also done well. It's up 3%. The one that did well the most for us was about 17%, which is Q&M. So the portfolio was roughly 2.2. For the quarter, we were up about 8%. But I guess it's also interesting to note that we had some stocks that did very well, like Propnex 57, Q&M 24. But it's also just a reminder that if you're running a portfolio, it doesn't matter even if you have one or two names doing well, no point shouting about it, because in the end, you still need the whole portfolio to do well. So even though we had some stocks that did up 60, but it doesn't mean everyone is up. So we were only up about 8%. Again, this is just for illustration, the performance, and just to give some transparency to some of our calls. The table on the right is just the performance of some sectors in the first for last month. So you can see that shipping did badly. So it was mainly because of the Sembcorp Marine. You can see at the bottom, Sembcorp Marine is down about 40%. And then what did well is healthcare, but that's mainly because IHH huge presence, and so it's about 5% up. The table in the middle, the small table there is just basically our performance. We were up about 2%. Again, this is just for illustration. And also it excludes monthly rebalancing, transaction fees, and dividend. We also take out we also exclude dividend income. This is just purely price performance. Okay, I think we can move on to the next slide. Okay, for this slide, I will just run through the SPH poems webinar they did with us. I mean, it ran for almost 2 hours. The table on the right, I think I plagiarized it from SPH. It's just to give you some rough timeline. The EGM is on July to August. So let me just run through some key points. Okay, so the second bullet point, so just a refresh. The spin-off is basically they're going to sell off all their media assets. I'm not even sure if you're calling selling off because they're actually giving it away. They're giving the 2 properties, they're giving REITs, they're also giving cash away, and also and the impact is that the NAV will drop 7%. They also wanted to highlight that actually there's no need for EGM because the assets were below 20%. But I think because of all the controversies and so forth, they decided I think they should want, and just to give a say to minority shareholders. So that's the deal. They're giving all the assets. So of course the 2 main questions that came up in this 2-hour chat was that, why give up? I mean, this is like, why give up so much? Why give up properties? Why give up? You're even giving up cash. So there were a few reasons for this, I think. So let me just run through it. So because the main one, number one, is there's going to be government funding for this new entity. Is CLG. That means a non-profit company. And then SPH cannot be seen to be bailing. No, the authorities, I guess, cannot be seen to be bailing out. I mean, if they were to just sell this, not only SPH shareholders getting some return from selling the media assets, and they are also going to get government funding. So this deal has to be a bit fair. It can't be like too one-sided. Of course, it's debatable. I mean, should they give up so much and so forth? But and then the second reason is, to qualify for government funding, this needs to be a CLG, government limited by guarantee. So this means CLG is not for profit. So even if you make money, whoever buys it not going to get any earnings from it. So number 2, you're not going to be easy to find any buyers because it's under CLG to qualify for government funding. And then of course you need to inject capital to keep it running. And of course, number 3, why not just dividend in specie or sell it to someone? Because there's this newspaper printing, the NPPA, the Newspaper Printing Act. So what this means is that there's a good Straits Times article there if you want to read. But what it means is that the ownership is restricted. There are basically 2 classes of ownership. There's management shares, and management shares is the one that's like, I think 200 times voting power on resolutions and on deciding who. It's like the special share or something, a golden share, whatever you want to call it. So that resides with the government, and the government also can determine like who gets all these shares. So obviously it's not going to be easy to sell to any third party, so this cannot be a third party transaction like the normal transactions that we see. So all this there's a lot of involvement by the authority. So, and as a result, that's why they had to give out all these things in return for government's involvement, I guess. The other main question was, what was the business after selling the media? Our rough estimate is that they, based on first half earnings, they're probably making 150 to 200 penny roughly after selling off the media, which is loss making. And then what they will focus on is the PBSA, which is student dom, which has the opportunity to be become a REIT. They also have one large data center, a JV with Capital DC, a 1 billion data center. There's also aged care. They have got M1 and retail malls. So ultimately, what they aim to be is to be a more fee-based income company. And of course, very little development earnings, something like what CapitaLand is doing. And then when you're more fee-based, recurrent type of earnings, property managers can actually, such as that, can actually trade at a premium. And they give an example of Brookfield Property, which trades at a premium to book. So I mean, that's ultimately their aim is to be more fee-based, a fee-based real estate company. Okay, I think that's it. I think I won't run through too much. I mean, I'm not sure if everyone was interested in SPH, but anyway, this is just to give highlights for those who were not able to attend. I hope that was helpful. But I think we can go on to Q&A. Thanks, everyone. I think Natalie, you want to go first? Yeah, thanks.
Okay, hi everyone. First question first question is about Capital DC. What is the main reason for the fall in share price? How does it compare to its how does its data center compare to Mapletree and Logistics Trust on the potential and their preparation for continued DC needs? Okay, so for Capital DC, we speculate two reasons for their fall in share price. Okay, first of all, the news floated to the market of about Digital Realty's potential data center IPO in Singapore, and of course that might be that might actually have impacted Capital DC. The second thing, of course, would be Capital DC has basically optimized their existing portfolio. They have unlocked value where they could. They have already converted non-DC space to DC space. So what is left for Capital DC in terms of growing share price will be, of course, some of the leases that will be expiring in the next 2 years in Singapore, which have opportunity for rental growth. But apart from that, most of the growth will come from inorganic acquisitions. And of course, in 2020, Capital DC only managed to acquire one small asset, and this was the ability to acquire was curbed because of the travel restrictions, which prevented the management from actually viewing the assets. Yeah. And I guess in general, the market is seeing that there has been a bit of a difficulty for Capital DC to acquire. Just a few months ago, they announced that they were going to expand the investment mandate. So this investment mandate, the expansion of investment mandate was partly because Capital DC, the deals that are coming to the market, some of them are in a portfolio. So it means it includes other assets like your infrastructure assets, your deep sea cables, your telephone towers. So these are all packaged together in an asset, in a portfolio. And Capital DC is precluded from actually being offered these assets or looking at these assets because of their mandate. So their mandate is only for data center type of assets. Yeah. So therefore, they actually expanded their mandate, and of course it was voted on by shareholders. Additionally, I think so this might not have been viewed very positively by the market because the Capital DC has always been favored as a data center pure play kind of REIT. Yeah. However, of course, KDC did mention that it is not their intention to be operators of your telephone towers, etc. And if they were to acquire any of these ancillary kind of assets, it will likely be on a master lease kind of term where they do not take on any operational risk, and they're just like basically landlords for these non-DC assets. Yeah. So I think in summary, once again, of course, we believe that Capital DC has suffered a bit from the news that the rumors of a new data center REIT by Digital Realty, as well as, of course, it seems that they're having a bit of a difficulty acquiring more data center assets. Yeah. Oh, sorry. The second part of this question is potential and their preparation for continued data center needs. So I think I'm gonna answer. I think this question is asking about how if any, would there be any disruptions for in data center operations, etc. So for Capital DC, especially for their co-location kind of assets, I think it goes without saying that they would have a on-site team in place. Even during the pandemic, during the lockdown, they actually had staff that will stay at the data center, to oversee the operations, in case anything happens. So I think, yeah, they are well prepared for the assets that they are responsible for. Yeah, okay, I'm done with this question. Another question for me, target price for of $4.38 for CapitaLand. Is it pre-merger, pre-demerger? So the answer is this is our target price. For now, this is our target price. After including the demerger. Yeah. Do you have a target price for after the demerger? That means for CLIM. Yeah. So no, we have not yet come up with our target price for CLIM. Of course, this is because CapitaLand is due to release more information, the information packet, but later on. I think it will come in the third quarter of 2021. So we are of course waiting for more information before we try to value CLIM. So we have a question about Dasin. I'll read out the question. The question is, any comments on why stock price has been exceptionally weak? ARA reported to come in as a 50% manager. Will that help in the long term? So for Dasin, yes, the share price has actually come down quite sharply over the last 3 weeks or so. Some speculations as of why that would have happened. Okay, so if you recall, I think towards the end of June, China actually listed nine Chinese REITs in the Shenzhen and Shanghai Stock Exchange. However, of course, these Chinese REITs, they are going to be infrastructure and industrial kind of REITs. And the reason why China has finally decided to open up its REIT market is also partly to ease the debt burden of the state and municipal counties in China, where usually it's the state that is the one that is funding your infrastructure cost. So some of the REITs are, for example, one of them would be like waste management, tolls. They own the toll stations for the highways. They're kind of REITs, and not really a traditional office, retail, hospitality kind of REITs. And it's foreseen that, of course, in the near term, that these kind of traditional REIT assets will not be the priority. It will be more of the industrial and infrastructure kind of assets, kind of REIT. Another thing to note is that, of course, for the China REITs, these are not really open for non-Chinese investors, so they're not like A shares, and so partly one of the reasons that could have impacted Dasin would be, of course, maybe if there were any foreign Chinese investors that were holding Dasin, they may have decided to switch to some of the China REITs. That could be one of the impact, I guess. Yes, the investment by ARA will likely help Dasin. I think they were exploring it more along the lines of co-sharing of resources, especially within the assets in the Greater Bay Area. So I guess some synergies there. Yeah, and possibly it was only a very small investment by ARA, but of course there might be potential for further collaboration or even asset acquisitions further down in the future. Yeah. Thank you. Okay, so I'm done with that.
Yeah, I think we can go to some questions for Timothy and also a lot of Sembcorp Marine questions. Terence, can you help out? I think they're also asking about the third price. Thanks.
Yeah, I'll take the question on the Oxley. Okay, the question is, any comments on Oxley's upcoming $1 billion 3-year bond with 6.9% coupon per annum? This rate is relatively high, and do you think the risk is high too? Thanks. It's not a $1 billion bond, it's a 70 million bond. So it came from it's part of their $1 billion bond program at the MTN, but they only raised 70 million for now. They don't have to raise the whole 1 billion for your yeah, is they can choose how much they want to raise. So for the 6.9% coupon is the highest in all the bonds, and that's based on the tenor, right? The tenor is 3 years later. So usually around 3 years later, the yield for this kind of property developers is quite high. So 6.9% is relatively in line with the market. So the rate is relatively high. Do you think the risk is high too? The risk will be higher for a longer tenor bond. So 3 years, yes, there'll be some execution risk with regards to the cash flows that will come in. So if you want a lesser risk, there's a 4.6% coupon bond that's maturing next year in January. So you only have to hold that for 6 months and then you get 4.6%. So if you want a lower risk bond, that will be the one to go for. Okay, that's all for me.
Warren, you want to do first? Yeah, thanks.
Okay, I'll do first then. There's quite a number, but I prepared the chart already, so yeah, just give me a moment. Okay, so I'll go through most of the questions that has been answered, like all this chart, excluding S&P 500. Okay, so first of all, I think let's go through Yangzijiang first. All right. First of all, the Yangzijiang has completed like wave 1, 2, and then this is an ongoing wave 3 of that. So my views remain the same as of like the few webinars ago. And then yeah, I think that in the longer term, there's a tendency to break up to the upside. All right, to complete the sub wave count of 1, 2, 3, 4, 5, means that wave 3 is likely to complete in the end. So wave 3 is likely to target $1.66 minimally. Beside that, if you can look at here, there's actually a wave 4. Okay, it's actually a pattern. So if you look at ABC correction, this one may be the last peak to actually goes up and then goes up again in the next foreseeable future. All right, just take a note of this pattern. Even if it breaks below, then it will become a flat. Prices are likely to find support at $1.30 going forward. All right. So the next one is for Franken. Franken, I remain neutral for now. You can see that price, although it still stays relatively well supported at the critical support line at $1.84. However, I think that based on the low volatility and momentum, price is likely to break below the critical support line, and then followed by a rebound at the support zone at $1.70 to $1.74 going forward. Okay. All right, so this support, yeah, is likely to be well supported. Going on for if there's a deeper retracement, I'll be 1, and then 2, and then there'll be a third wave down at $1.44 to $1.47 if there is a stronger retracement going forward. All right. Okay, so next one will be OCBC. OCBC, I think I remain bearish for now. The target has really rejects the 50-day moving average, exponential moving average. Price is likely to break lower. The only way to play the track will be breaking the immediate resistance at $12.52 to $12.76. We've given the current price action, I think highly not so. Immediate resistance at $12.20 will likely to be reject. There will be a strong selling over there as well. Okay. There's a question on Hong Kong land whether there's a bullish flag. Unfortunately, not really. If you consider this as a bullish flag, yes, maybe there is, but I consider this as a failed breaking of the falling wedge. Initially there was an upside, but price decided not to go ahead above $5. Okay, so you can see the price actually has sold down. It's kind of well supported right now, but you can look closer. There's like a consolidation of candles. So if price is going to break below $4.68, then we can see that near-term support at $4.20 to $4.36 is likely to be a rebound. Okay, but if you factor in as a flag, okay, then $5 will need to be broken once again. But given the current price action, it is highly unlikely to do so. Okay. So first of all, our next one will be APAC Realty. I recently issued a report on the on PropNext. So I think PropNext, they are quite kind of like correlated to each other. First of all, you can see that price actually broke the multi-year resistance after the rolling bottom, and then it has break 0.690. So it's on the route to 0.825 to 0.875 resistance in the long term. Looking at the daily chart, panel has been broken. There's a successive bullish candle going forward. All right, so this is the APAC Realty going forward. So the next one will be the ST Engineering. So ST Engineering, I remain neutral. So I'm not much comment on it, except the fact that price has been testing the resistance zone quite a number of times. Intra double bottom has been seen, but this may be considered as a head and shoulder as well. Okay, so if price do not break $3.94 or $4, then you can see that there might be a likely correction down to the support at $3.39 to $3.54. All right. Some power was relatively doing well until it get down. I think on the 9th of June, which is a month ago, and then price has been hovering around it. Price today gap up, broke the resistance at 0.90 cents. But it still have this resistance at 92 to 95 cents to be contested. Despite this breakout of the bullish flag pattern, the gap down actually make price to go down. So in fact, if this is not going to be supported, not going to break, then likely price is going to revert back to 0.920, 72 cents to 76 cents and 76 cents, right? Support region. Lastly, I think Thai BEV remain weak. Despite the fact that it can't break the immediate resistance at 71 to 71.5 cents. So hence I'm looking at the long-term support at 63.5 and 65 cents going forward for Thai BEV. This will be the last touch of the flag. In fact, it may even break lower to 61 cents before rebound. First Resources, I'm still bearish about it. My view don't change after like 2 to 3 webinars we have shared. Long-term support remain at 0.99 to $1.10, especially if this candle close at bearish engulfing, then we are likely to see further downside going forward for First Resources. All right. CapitaLand China Trust, not much comment for now, ranging within a rising wedge. So no further comment for this. Okay. Maple Tree Industrial price has been like, I issued a report, I think mid of June. So price is likely to break this resistance zone after much testing. If it breaks above, and then the next target at $2.92 to $2.96 will be the next target as well. Long-term target $3, and then followed by $3.20 is my ultimate long-term target. ESR REIT, I think is strong. Last Friday at as Starhill Global and then this AIMS APAC REIT all have a same structure. So I'm likely to see price targeting 50 cents in the short run. All right. Land Street also, finally, after issuing a report in December and January this year, it has already reached my first target at 0.75. Ultimate target will be at 0.94 cents going forward. Multiple resistance, like I shared 2 to 3 webinars ago, has been broken. So this bullish move is likely to be very strong going forward. Next one will be UMS. UMS still UMS gap up above the panel. So despite some pullback, I think the immediate resistance zone at $1.46 to $1.49 will be the new support term resistance zone. If not, it goes back to $1.34 before a rebound. In either way, I'm still very bullish on the UMS, all right, as compared to AEM. So if we take a look at AEM, all right, the up move is still relatively weak. First target is here at $4.24, but there's likely a very sell down upon reaching $4.24. All right, Innotech, 5-way symmetrical triangle A, B, C, D. E wave is likely to be well supported at 0.915 or 0.870. Crucial resistance zone, even though it has formed a rebound and wavy potentially in the future, the $1 and $1.04 is a crucial resistance need to break to confirm the upside. Longer term wise, we'll look at the trend. Is still immediate uptrend, but if you look at the weekly chart, it's still not very strong. It is starting to rebound. All right, so you can consider this as a falling wedge that has been broken. Okay, so yeah, right now we are still okay. If you consider this maybe a new uptrend, but you consider that we need to break $1.50 in the long term to go up forward. All right, so with that, end of my presentation on the technicals. So I believe the rest of my colleague would like to answer other things as well. So I pass my time back to Terence and my colleague as well. Thank you.
Oh, sorry, I think my screen, let me just turn off the virtual background first. Yeah, thanks. So there are a few questions. I think I'll just answer them in order. So we have one question. What is the OCBC UOB target price? So our latest report on OCBC and UOB is in May. So there's been no change to our target price for OCBC and UOB. The target price for OCBC is $14.63. The target price for UOB is $28.70. So that's one note on this. Again, there's no change to the target price, but of course the MAS is currently reviewing the dividend cap on these two, or on the bank's dividend. So there could be some catalyst on the horizon for the banks. Now, of course, the OCBC and UOB they distribute half yearly dividend. Of course, DBS they distribute quarterly. So if they make the announcement soon, then there's a possibility of them announcing the resumption of 2020 dividends in the latest upcoming quarter. But again, there's no certainty now. Yeah, let me know if I answer your question. Yeah, then like what Paul mentioned, there's also some questions on Sam Marine. So maybe I'll just read it out. Can we have your input on price for Sembcorp Marine before rights announcement about 20.5 cents? So and then there's the second one is current price of 12 cents a fair price? And then third question is, what is the theoretical price after X rights? So I'm not sure if you mean like what's the input on the price before the rights and also the current price. Just to put it out. So we don't have any coverage on Sam Marine, but we just follow Sam Marine of interest because of the coverage on Capital Corp. So I think the question is what is our view of the share price of Sam Marine following the announcement of this merger of Keppel, potential merger with Keppel, I think they really don't have much options on the table, especially for Sam Marine at this moment, because if they don't merge with Keppel, then the whether they can compete effectively and whether they can scale and achieve some cost efficiencies will be a question mark in the future. So for them, if they don't do the merger now, then it will be harder for them to compete in the future. So that's probably our view. But the theoretical price after X rights is 12 cents for. Yeah. One more question here. Is it adversarial for the Sam Marine minority investors that Temasek Holdings has proposed 3 rights to 2 existing shares? What is your opinion for these unfortunate investors? Should they proceed to subscribe to the rights or dispose of the shares before the rights? So I think maybe I'll answer the first question first. This rights issue, the 3 rights to 2 existing shares, is proposed by Sembcorp Marine, and I think one thing needs to be clear. This rights issue is for Sembcorp Marine to participate in the invest in the future growth and also to fulfill some of their existing contracts. So it's not for them to acquire the Keppel O&M business. So for them, this rights issue is also necessary to pull down their gearing and also help them to at least ride out the downturn. So we don't think it's adversarial. In fact, is given the circumstances, is almost necessary. Then the second question is, should they proceed to subscribe to the rights or dispose of the shares before the rights? This again depends on the view of the investor in terms of whether you can take a long-term view. For us, the near term will be very, very challenging for the Sam Marine shareholders, at least because there will be a very massive dilution in terms of the number of shares that will be released into the market, because it's 3 for 2, and they're going to raise $1.5 billion, which is about half, nearly a third or half of their market cap. So the rights issue will lead to a massive dilution, and should the merger of Keppel O&M and Sam Marine take place, then they will distribute the merged entity shares to the Keppel shareholders. So in the near term, we believe there will be some pressure to the share price of Sam Marine. But if you take a longer term view, then obviously the merged entity will be a stronger one, and they will create this global champion in terms of the shipyards. Obviously, if you compete together, then there will be revenue and cost synergies as well. So Sam Marine is not in the near term, we are a bit more bearish. In the longer term, it will probably be slightly better. Let me just see if there's any more questions. Okay, so there's one more question. Please comment on the 3 banks and telco. So I'll leave Paul to answer the question on the telco, but maybe some commentary on the 3 banks. I think like what I mentioned slightly earlier, for us the main catalyst for the 3 banks are obviously the removal of the dividend cap. So MAS recently announced that they are currently reviewing the 60% dividend cap on the bank's FY19 dividend. So and according to MAS, they are going to make the announcement soon. But as to when they are going to make the announcement, I think nobody knows. But this is currently under review. I think the base view, our base view is that MAS will lift the dividend cap on the 3 banks, because the 3 banks are already very well capitalized, and the well capitalized in terms of the CET1 ratio. So the CET1 ratio for the 3 banks are now in the range of 14.9% to 15.3%. So when your CET1 ratio is so high, then versus what for them is a comfortable range is about 12.5% to 13%. But when it's so high, when you're holding so much cash, then what happens is that your ROE will come down. So for us, because the banks have made such significant provisions over the last financial year, in financial year 2020, so and so well capitalized. In fact, all their ratios are above the MAS requirements. So we think the banks, the central bank is more likely to remove the dividend cap on the bank. Given the latest scenario, I think in our last report, what we view as the likely scenario is they could make an announcement sometime in September and October, because that is when DBS will announce the quarterly dividend. But if they announce it in the next few weeks, just before the bank's results, then we think the banks could resume the dividend, because that's what they say, like they will resume the payout of the dividend, and also there's a possibility of a special dividend, also, though maybe not so soon, but there's a possibility of the special dividend. So once they do that, then we believe that the share price of the banks will rally. Yeah. So let me know if I answer your question also. Thanks. Others continue and see. Yeah, okay. So there's another question also. Hi Terence, since you are live now, do you cover Great Eastern under financials? If not, any off-the-cuff views? GE is heavily exposed in Malaysia, and how much bearing does GE have on OCBC? OCBC has around 90% stake in GE. Yeah, so thanks for the question. There are a few questions. So I'll answer the first question first. We don't cover. We have no coverage on Great Eastern at the moment. Yeah. So off the cuff views. Yeah. The reason why we don't cover Great Eastern is because it's very challenging for us to try to forecast the financials of Great Eastern, because the wealth management insurance business is almost impossible to try to forecast. And if you try to forecast, it's almost like your view is as good as mine. So if you cannot forecast, then there's no point covering also the company. Of course, it's possible to just do an estimation, but to have a very clear estimation is not possible. So how much bearing does GE have on OCBC? It's quite significant. About 40 to 50% of their revenue comes from GE. Yeah. Okay. Let me just scroll down. Okay. What's your view on OCBC? So there are few line items, right, for OCBC for us to consider. The first is in the latest financial quarter, their net interest income was actually positive, flat and negative already. So for full year 2021, we're actually expecting for their net interest income, which is also the biggest line item, to see a mid-single digit growth. In fact, mid-single digit should be the baseline growth, because NIMs have stabilized. And based on our recent conversations with them, they also mentioned that the NIMs have stabilized. We'll provide more of this during our strategy and stock picks webinar this Saturday. But for the banks, what they see is the NIMs have stabilized. So net interest income, they expect 4 to 5% growth. The Great Eastern business is also doing well, also doing well for them. And for the wealth management side is a main driver for them. They expect for full year 2021 a double-digit growth. So for our in-house view is we expect the non-interest income, which includes GE, to grow by about 20% for FY21. So you have net interest income and the non-interest income also being boosted in FY21. And then for the general provisions in first quarter, OCBC actually did a reversal of the general provisions. Not reversal, they just did a one credit cost adjustment to the thing. So we expect for second half 2021 that OCBC will likely do a reversal of the general provisions, similar to what DBS did. So all this is all very confusing. But when we put all of this together, what we're expecting is for OCBC to report record profits in FY21. So our baseline view on OCBC is positive, and is one of our the counters where we have a very, very strong high target price on also, $14.63. Yeah. That's all. Let me just continue to scroll down. Okay, we got another question. What is the impact on Keppel Corp from the Keppel O&M and Sam Marine merger? Second question is it positive for Keppel Corp shareholders? So for us, for Keppel, the impact we see the merger of Keppel O&M and Sembcorp Marine as overall positive for the Keppel Corp group, because the REITs business is actually a very challenging business. So for Keppel to continue competing in this space, we see more. We see more challenges for them, especially if you look at the last few years. There's a lot of impairments. There's a lot of write-off. So for Keppel to be able to spin off this unit to Sam Marine and allow them to merge, I think that when Sam Marine and Keppel O&M merge, then they will be able to realize more synergies together as a merged entity, and that is positive for the merged group as a whole in the longer term. So for Keppel, if they're able to spin this off and focus on some of the rest of their units, this will be the overall net impact on Keppel will be positive, because they can just focus on their property infrastructure business and all the other Vision 2030 businesses. So overall, there's two things. We view this as positive for Keppel shareholders, because they're going to receive a cash infusion of 500 million if the merger takes place. And then there's a second MOU that they signed with Kyanite Holdings, which is a wholly owned subsidiary of Temasek Holdings. So if the merger take place between Kyanite Holdings and if Kyanite Holdings take on all the REITs and all that receivables thing, then Keppel will essentially be rid of the O&M business, which we think is holding the Keppel share price back. So overall, we see the recent transactions as overall positive for the group, and we believe will lead to an overall re-rating of the two entities. Let me know if I answer your question also. Thanks. Let me just continue to scroll down to see if there's any more questions on Keppel or the banks. Okay, so there's one more. Then what's your view on UOB versus OCBC? Essentially, they are for us. Essentially, there's not much difference. Of course, there are some differences, but for UOB and OCBC, for them, the two of them are key beneficiaries to the improving macroeconomic environment. And we spoke to both of these banks recently, along with DBS also. For them, they see loans growth improving and the macro environment also improving. Non-performing loans for them is also stable. So for on the macro front, there's not much difference for these two banks. But UOB is more conservative in terms of the reversal of general. In our view, UOB is more conservative in terms of the reversal of the general provisions for the second half of 2021 compared to OCBC. So for the second half of 2021, we actually expect UOB to continue to make general provisions, even though it will come down. But what UOB is guiding for is about 29 to 30 basis points of general provisions for the second half 2021 versus OCBC. They are just expecting to reverse out some of these general provisions already in 2021. So comparatively, we think the recovery for UOB will be slower than OCBC, because they're going to take some time to reverse out these GPs versus OCBC. So between the two, we are more positive on OCBC at this moment. Okay, so there's another question. why is DBS not your bank pick? Is it fully valued? No, DBS is actually our top pick. DBS is included in our absolute 10 portfolio. So for us, DBS is also the theme for the three banks is the same, like improving net interest income. Non-interest income is going to improve also, reversal of general provisions. For DBS especially, they will also see the contribution from the two acquisitions that they make, Shenzhen Rural Commercial Bank and Lakshmi India Bank. So for us, we are, in fact, within the sector, we are most positive on DBS Bank. Okay, yeah, I think that's all for me. I'll just hand over to my colleagues now. Thanks.
Yeah, okay, thanks. Let me just add on to the Sembcorp Marine. I think if you're a Sembcorp Marine shareholder, I think you have to be a bit careful. I think, as you know, the rights issue is 2 for 3. So if you subscribe to the rights, you are basically doubling down on your position. So if you have 2, means it's 12 cents, so it's about 20. Let's say 2004, then 3 times 8 cents, so you another 24. So number one, you have to double down in your position if you want to take the rights. So whatever allocation you had for Marine now, you're going to double it. So that's number one. Then number two, if you don't take up the theoretical extract price now, I think it's 97 cents. So if you don't take it up, you're going to lose money. If you take it up, you got to double down. So there's 2 issues there. Then the third issue is, like what Terence said, there's 2 big overhang for you. So assuming the rights issue is over, you might have another rights issue because they might have to pay 500 million to CapitaLand to do the merger. Then you got another, right? Then the fourth overhang is that, like Terence also mentioned, assuming the deal with CapitaLand is over, CapitaLand shareholders are going to get a lot of shares for free, because on paper it's going to be like free shares for them, and they are, I wouldn't say dump it, but there's a high chance they will just sell it off when they get. So there are a lot of challenges ahead if you're a Sembcorp shareholders. I mean, I hate to say this, although the share price is down, so there is still a bit of risk out there for the share price. Yeah, okay, just wanted to clarify that. The other thing is that we had this question on what's the difference on the accumulate and neutral. So we do get quite a bit of this question. So let me just share my screen very quickly, just to clarify. I hope you all can see the screen. Okay. Anyway, in all our reports at the back, or maybe second page or second last page, you will see this, and this will show basically our view. Again, please don't ask me, why is it not 25, why 20? These are just some ranges that we have made many years ago. So a buy, you could say, is more like a strong buy. Accumulate is like a buy. So this is the expected return, including dividends. So this is not just the price return. This is the return that we expect plus dividends. So that's how we get that. And of course, sell. And again, just want to clarify. No, these are just some of the ranges. I mean, it's a bit arbitrary, like 5, not 6 or 7, but this is just a rough, just to give you a rough idea how we do it. Of course, every broking house could have a difference. Okay, just want to clarify that. I think Timothy, you want to go answer some first. I think there's also one question on the minutes. Do you want to try that, Timothy? And also there's something on bonds before I continue with the rest. Thanks.
Yeah, okay. There is a question on can we get the 4.59% bond through Phillip Securities? So this is for the Oxley bond that matures next January, 31st January. Yes, you can get it through Phillip Securities. So you just have to call the bond desk at 6212-1818, or you can just email them at bonds@phillip.com.sg. Then they'll be able to quote you for the bond. But do note that this is a wholesale bond, so they come in lot sizes of 250K. Okay, there is another question.
Okay, it's okay. Let me just do this. I think it was typed as answered, but anyway, there's this question: how will this coming Thursday's meeting minute release of Federal Reserve impact both US and Singapore market? You want to try that, Timothy, or you want me to?
I think you can go ahead. Yeah.
Okay. Okay. Anyway, we don't expect much impact. I think we have to be a bit realistic. I think before they release the minutes, all the Federal Reserve board of governors would already gone through the minutes, and they wouldn't want to message anything that they don't want to. So it's a bit of almost like a press release, number one. So we don't think there'll be much impact. And number two, just a reminder, I think most of you might know, but just a reminder, when you hear a lot of this Fed talk, there's only three people that matters the most, which is the Governor Powell, the Deputy Governor Clarida, and the FOMC Vice Governor Chairman Williams. The rest is just a lot of noise, because these three will dictate what happens in the FOMC meeting. So the rest is always nice to hear. There's a lot of noise everywhere, but in the end, because all these Federal Reserve members are speaking almost every day, so there's a lot of noise. But these are the three people you must listen the most. The rest, I mean, listen at your own convenience. I just wanted to remind anyone. Anyway, just to answer, we don't think the minutes will. It's almost like a virtual press release. They probably vet it through very closely, and I don't think they want to knee-jerk anyone. The media might just talk about maybe somehow the members will be voting on the dot plots. Maybe some are a bit more aggressive. But again, the three people that are most important is to focus on what they say and not what the rest say. Okay, I'll quickly just run through. There was one question earlier. Sorry, we didn't answer. Any updates on MM2? Okay. Okay, this is just our own. We don't cover MM2, but we think that there could be a lot of positive catalysts for them. Firstly, the main one is the reopening. So of course, if they reopen, which is, I mean, of course, nobody totally knows, but there's a good chance there's a reopening of all the cinemas, because right now I think the capacity is 50. I think if you go and book a seat now, you can book 2 seats, then there's a gap of 2, and then I think half the cinema can only be filled. So that would be number one. Then number two, there's a lot of blockbusters coming out. I think we all know there's a lot of Marvel blockbusters, so that could also help the cinema. So number three catalyst could be the listing, which they already mentioned in the that they already submitted the document. So that could be another catalyst for them. Number four is he has a pipeline of movies. So as you know, MM2 is not a studio, so they don't, maybe like TVB, or they have their own artists. So they will find good content, produce it, sell it to investors for a margin, and then and that will be screened, and the investors will get money. If our Boys to Men make money, then they will get the big return. But most important is they've got a pipeline of almost 90 million of projects, and the margins could be 30-40%, I mean, depending. So that's the fourth catalyst. Then the fifth catalyst is unusual. Of course, there's no concert now, but of course, the reopening will also help them, number one. And they've also started to do online. I'm not sure who bought it, but I knew there's a JJ Lin selling for $38, $68, or even $100. Of course, the 100 plus, I think they give gifts or something. So that is another avenue to kind of help unusual, and there could be more artists, because MM2 created a joint venture, and I don't think that they did it just for one concert. It could be multiple. Again, we do not know, but I think that could be one way to clarify. So there's a kind of number of catalysts, but the main one is a reopening of the cinema and group gatherings around. I guess that could be the catalyst. Apart from that, nothing really major that was briefed in on the meeting, but I think this we think are some of the drivers for the company, because they are probably the latest in terms of the cyclical. If there's a recovery, reopening, they are the ones who would a clear beneficiary, I guess. Okay, I think you okay. I'll answer one last one before I move to Natalie. I'm not sure if on the telco sector, and okay, on the telco sector, basically there isn't anything going on. I think with the borders closed, they are still missing 20% of revenue. The only one, so it will be a bit of lackluster earnings. You can look forward to some dividends for StarHub. They committed to 5 cents. So the yield, I think, at the current price, maybe 3 to 4%. As you wait for borders reopening and earnings coming in. So number one for StarHub. Number two for Singtel. Again, the earnings will be lackluster, but there's a lot of talk on them restructuring. So they could be selling in Australia. They could be selling some of their towers, but we are a bit more neutral on it because sorry, we mentioned this before, but no, these are sale and lease back. So this is like you're selling your factory, then you lease it back. Ultimately, it depends how much you want to rent, and both of these are almost like like from one party to another. So I don't see that much of a value, because in the end, the value of the sale and lease back depends on how much you want to pay. That means if Singtel sell their towers, it depends how much rent they want to pay for it. So I mean, they can always pay higher, then they can pay less, they can pay higher, then get a big upfront gain. So I'm not sure how much of a value add is that, or is it, it's just a refinancing. You take your house and refinance. I'm not sure if that's a lot of value add if you're a house owner. Okay, so that's what we think. The main one, okay, but the broad theme for the telcos, I think SPH kind of highlighted it very well. 3G, the telcos did well. 4G, the value, all the apps did well because all your Facebook apps and they are the ones who took up a lot of value. So 5G is the unknown. So the 5G is the opportunity for the telcos, big picture, for the telcos to extract some value. But again, I'm not sure how they're going to do it. Even the telcos are also unclear. But the battle now is so that, like in 4G, the Facebooks, all the apps are the one that monetize most of the value, captured most of the profit pool. And the telcos were just there to just be a pipe money, nothing much, not much value add. So the big battle will be 5G. But again, I'm at this point in time really not sure if the telcos can actually move the needle on that. Okay. Okay, I think that's it for me. There's one more. What's your view on Riverstone? We don't cover Riverstone, but in general, all the glove makers might be just move sideways because the issue right now is that no one knows how much more glove prices have to correct. The margins, the glove makers are making now 60%, but pre-COVID, they were making like 20%. So there's a lot of uncertainty now, how much more the prices will come down, margins will correct, will they go back to pre-pandemic level? So that's the big unknown. Okay, I think we're already 12:45. I'm not sure how much more questions we can take. Yeah, anyone else has any questions? I think otherwise we might have to end it now for Weiren. Thanks. Natalie, you want to answer on the SPH REIT or? Actually, there's a briefing on SPH REIT tomorrow. I think maybe for following week, we can give you a better answer. Yeah, we will give you a figure on the ground on SPH REIT because the question is those holding SPH REIT to hold or sell. Let us give you a better answer next week. We will do a figure on the ground because I know, again, we always do this because most people, investors don't get access to all these briefings. So Natalie or Jehu will just give you guys a briefing on it, on some of the key points. So I think hopefully that can answer. Next one, APAC Realty. We dropped coverage on APAC Realty because you can get whatever real estate agency exposure through PropNext. So that's why, and due to resource issues, I kind of dropped the APAC Realty. QMN Dental target price is $1. Okay. Anything else, Ned? You want to do anything? You want to answer anything, or you think we need to go off that?
Okay, just very quickly, one question about the DPU growth of REITs. So I think in my earlier chart, I actually categorized Manulife and Prime into office bracket overseas. Yeah, so that is actually in reference to Manulife and Prime. For the DPU growth of Singapore office REITs, unfortunately, the only other Singapore office REIT exposure we have comes as a diversified REIT from CICT. Apart from that, we do have the consensus forecasted DPU growth. Of course, this is a consensus forecast based on all the other analysts' views. So for Keppel REIT, DPU growth in FY21 would be 3%, as well as for, if you want to look at Suntec REIT, DPU growth is 16.2%, but do bear in mind there's some retail exposure from Suntec REIT. You can also refer to the latest REIT Monthly, where I actually created another table to show the historical DPU growth, this DPU yield, yeah, and also based on consensus forecasts. Okay. So just like to just follow up on the Tasin, because I see some other questions. For Tasin, in terms of fundamentals, and in terms of outlook, there hasn't been any news, positive or otherwise. We actually spoke to the company, and yeah, they also said, like, in terms of China recovery, the recovery is pretty much on the way and opening up, as the retail industry is actually also opening up because of how the vaccine, the pandemic is being controlled in China. So fundamentally and operationally, there isn't much change. Yeah. Okay, from an FA point of view on CapitaDC, are there any development news that is negative on their business in short or mid-term view that the TA outlook has indicated to be bearish? So for CapitaDC also, they have been relatively quiet. Fundamentally, there's not much change. In terms of their portfolio, the largest exposure is to Singapore, and most of the Singapore assets are, co-location assets, which are the assets that are be able to charge the highest rent because there is some sort of provision of the fully fitted equipment, as well as some management, some management services such as the provision of redundancy, power redundancy. So that in terms of for the Singapore market, as mentioned, it accounts for about more than 70% of CapitaDC's net property income. And these leases are on a shorter lease term, so about 2 years, 3 years, and a lot of them are actually expiring, in 2 years' time, which will actually coincide with the increase in data center rents in Singapore. Given that the data center moratorium is still in force. So in terms of fundamental view, we can expect some sort of rental growth from the co-location data centers in Singapore, and more or less is still relatively positive from a fundamental point of view. So as mentioned, I think that the pushback from investors actually comes from the lack of acquisitions, the lack of inorganic growth that has not yet come to the market, since the start of 2020. Yeah. And of course, as mentioned earlier, the potential listing of a digital realty data center trust. Yeah. Okay, I think that's all for me. I pass the time back to Paul to bring the session to close.
Yeah, thanks everyone. Sorry we couldn't answer everything, and there were some questions about the recording. So we do record it in our PhillipCapital YouTube channel. I'm not sure why it's not on Stocks BNB, but ultimately it's the same. We just load it up in YouTube, and then if you want to listen, I mean, for whatever reasons, you can actually just go to the YouTube channel. So in the meantime, so thanks everyone for staying back and listening to us. So sorry about last week, there was some scheduling issues, so that's why we had to cancel. Apologize for that. But we hope to see you next week, or even attend our this Saturday, our strategy session. I mean, if you have the time, or listen into any of our listed company webinars. So in the meantime, thank you everyone for all your questions. We might have missed, I think we might have missed one or two, so sorry for that, but just go to our website, Stocks BNB, and type it out. And thanks everyone and for listening in, and take care. Bye.